Well, today we're going to talk about Chapter 7, and I'm looking in the book on page 223, and the topic is cost allocations by departments, joint products, and a little bit about byproducts. And some of the objectives we're going to talk about is to talk about the strategy behind cost allocations, some ethical issues, some methods used to allocate service department costs to production departments, and then talk about some implementation issues depending on what kind of method we choose to use that we'll go over. So we're also going to talk about joint products and allocation of overhead costs to what we call a joint product, and we'll talk about that later. And so um, part of what we need to do then is talk about the strategy behind cost allocations. And again, page 224. And the goal is to get as accurate as we can departmental and product cost so that we can determine how cost efficient a department is or a product is. Okay, that's the first thing we need to think about. The second role when it comes to strategy and allocation is to motivate managers, hopefully to give them achievable goals that will help maximize their effort and give them goals to achieve in terms of cost management, cost strategy, proper pricing, and so on. Item 3, provide the right incentives to make decisions consistent with goals of management, right? So if we have goals and we can use cost allocations to help us achieve those goals in terms of what a product should cost, how much a service department should cost, and so on, we can use that to have reasonable and consistent goals. And then finally, to determine rewards and clearly determine who was best at cost management, who was made the best decisions, and cost allocations will be a way for us to evaluate that. Oops, went way too small there. So, for cost allocation bases then, one thing to keep in mind is you really want to think about the most objective basis for cost allocation, and they're talking about that would be at what they call a cause and effect relationship. So the best that can be determined should really be what you use to allocate cost. And so quite often that might be something along the lines of um, machine breakdowns and maintenance costs. So we're going to allocate based on one thing happening that the cause has an effect on something else. Other alternatives exist in the absence of cause and effect relationships, potentially what they call ability to bear. Does one product have more ability to bear allocations than another, or the benefits being received? And we'll talk a little bit more about those also. Some of this cost allocation basis information is on the bottom of 224 and also on the top of 225. And I should also mention that these four goals or roles of cost allocation are on page 224. Some ethical issues to be thinking about when it comes to cost allocation, and it's important that we think about ethics in accounting and doing things the right way. And it really comes into place. The first thing I mentioned in the book is when we're costing for a governmental contract. Quite often, if a company is going to get a governmental contract, it's what they call a cost plus contract, where the government will pay you cost plus a certain number above that cost for your profit. And of course, how we allocate cost, overhead type things, will of course affect the cost that we're marking up. And so what they say is the temptation for a business is to allocate more costs to product lines that are being supported by government payouts or sales to governments rather than products that are sold to the competitive market where there's lots of competition and the ability to increase the price probably isn't there as easily as it is with a government potentially. And so there's an equity or what they call a fair share issue when it comes to this. And of course that's why governments have auditors, and that's why they like to see a company's numbers to determine is the cost that a company came up with, does it truly make sense? Some other ethical issues involving costing is tax treatment, and basically when we're selling overseas. Increasing costs of products purchased in high tax countries or countries where the firm does not have favorable tax treatment, by increasing those costs, those products sold overseas in high tax countries, you can get some tax benefits. Okay, of course, international authorities, try to watch that also, especially if there's some regulation involved. So there's temptation to allocate costs to products sold overseas and products sold to governments because of some potential benefits by doing that, as opposed to products that are sold on the competitive market. When it comes to allocating overhead, there are three general approaches that we'll talk about, and you can see what they are on the screen here. And they're listed for us on page 226. And basically Exhibit 7.1 on the top of that page talks about the volume-based approach, the departmental approach, and the activity-based approach. And just kind of walks you through some of the steps done very simply. It's also, of course, described more in the page on page 226 also. We'll go through some examples of all. But volume-based is basically saying, let's look at a single cost pool to allocate based on volume. Departmental will be allocating overhead by departments, and then going from production departments to products themselves. And of course, activity-based allocates overhead to activities that are involved or done to produce something, and then allocated from production activities down to specific products. Okay, obviously, volume-based is the simplest, departmental is a little bit tougher, and activity-based involves the most work to be done. We also know that in terms of relative numbers, that the best numbers are going to come out of the activity-based approach, based on everything else being equal, because there's more steps in the allocation, more things are involved to allocate the numbers, and so you get what we'll call maybe a more accurate result. So we'll talk about the departmental approach first, mostly described for us then towards the bottom of page 226. Involves three phases. We're going to trace direct overhead costs, which we always do, and allocate common overhead to both various production and to service departments. Okay, so we're going to, first of all, thinking about departmental, we're going to classify a department as either being a manufacturing department or being a service department. Okay, so a service department might do services that benefit potentially all manufacturing departments or some manufacturing departments, but not others. But service departments are supporting manufacturing somehow, some way. And so those service department costs need to be allocated to the production departments, is really what we're trying to figure out. So we're going to allocate service department costs to production departments, and then we're going to allocate production department costs, once those are all determined, down to a product and get a product allocation. Okay, so the book's going to give us some examples here. They're going to give us just a very basic manufacturing company that has 2 service departments and 2 production departments. And the service departments, of course, percent of what they do will be allocated to each of the production departments. Okay. The 3 phases of departmental cost allocation, it's on the top of page 227, and you can see what those phases are. Phase 1, trace direct costs, okay, which is always the easy cost, and allocate indirect costs to all departments. Okay, so that's step 1 right here. Manufacturing direct costs and indirect costs. We trace the direct and we allocate the indirect to the various departments. We've got 2 service departments and 2 production departments in this example. Phase 2 is to allocate the service department cost down to the production department. So we've got 2 service departments, and we're going to take their cost, allocate them to the production departments. Okay, and so phase 2 means we're going to allocate service, and of course we've already captured any indirect production from phase 1 plus the direct. And then so after phase 2 we're going to have all costs, overhead and indirect costs have all been allocated and captured by the two production departments, and then we'll allocate down to product once we've got phase 2 done. Okay, so obviously this is a departmental approach. We've got 4 departments here, 2 service and 2 production. And so the example they're going to show us here, they start this in the book on the bottom of page 227, and it's Berry Company manufactures 2 products, and they have 2 production departments, which is P1 and P2. They have 2 service departments, S1 and S2, and Berry uses direct labor hours to allocate indirect labor and machine hours to allocate indirect materials. Okay, so it's a volume-based approach using 2 different allocation bases, labor hours and machine hours. And so you can see then from the data given to us, you can see the labor hours by the different departments, you can see the machine hours by the different departments, total hours here. You can see what the direct costs are, which don't have to be allocated, and so you've got 36,000 of those. And then you've got the indirect labor, indirect materials that are not directly traceable and need to be allocated somehow. Okay, so that's what we have to figure out, is this 25,000 of indirect labor and this 5,000 of indirect material. So phase 1, and what you see on the screen for phase 1 is also in your book on 228, and there's more detail in Exhibit 7.4 than there is in this PowerPoint, so make sure you're looking at Exhibit 7.4 on the top of 228, and it kind of shows you in a little bit more detail how some of the numbers are computed and arrived at. Basically what you see on the top half of the screen, the direct labor hours and the machine hours, was given to us from the previous slide, and then all they did was just compute the percent of each department for direct labor hours and for machine hours. So S1 is 15% of 12,000 and so on, adds up to 100% for each. Okay, so once we have our percentages, now we can do a little bit of allocation. So we've got our direct costs, which came from the previous screen. Those are directly traceable. There's no allocation needed. So that's just given to us. But then we allocate based on our percentages up here. Okay, and so this 3750, if you look at your book, we have $25,000 of indirect labor in total that's being allocated to each of the 4 departments based on these percentages up here, 15, 10, 30, and 45. Okay, and then we've got 5,000 of indirect materials allocated based on these percentages based on machine hours right here, 10, 5, 35, and 50. So 10% of 5,000 is 500, 15% of 25,000 was 3,750. And the book does a good job of showing you each of these calculations. Okay, so that was the departmental approach, phase 1. Okay, now with phase 2, allocation of service department costs. Okay, so if I go back here, we know that we have now allocated all the indirect, okay, but now we've got these 2 service departments, each with a pool of cost in it. 5,850 for Department 1, 8,250 for Department 2, and both of these pools of cost need to be allocated to the production departments. Okay, because once they go to the production departments, then we're going to allocate to the actual products. So phase 2 then is to allocate the service department cost. Okay, and so they're going to talk a little bit about what they call a reciprocal cost flow. In other words, the service departments may help support each other. Okay, so potentially a service department doesn't just support only production. One service department could provide support services to another service department. Okay, and that's what they mean by reciprocal cost flows. Exhibit 7.5 on the bottom of 228 shows those relationships. And that's really what you're going to see is something just like that. When you do the homework problems, they're going to give you some tables exactly like that. And so if you look at Exhibit 7.5, bottom of 228, Service Department 1, it says 40% of its cost goes to Service Department 2, 30% goes to Production 1, 30% goes to Production 2. So 40 plus 30 plus 30 equals 100%. In Service Department 2, it gives 10% of its cost is used for Service Department 1, 30% for Production 1, and 60% for Production 2, which again adds up to be 100%. So those percentages are very key, and we now know that each of the service departments does something to support the other service department. And so we need to take that into account, and we're going to take that into account with three potential methods: direct, step, or reciprocal. Of course, all of them have different pros and cons. All of them will give us slightly different answers, and typically the third one is usually the most difficult one, but gives you the best answer. So we'll go through examples of each, which the book also does. And so then page 229, we'll start the direct method. And it's really key that you look at the top half of 229, where they look at each service department and they figure out then the net service to both production departments from Service Department 1 and then from Service Department 2. And this 30 and 30 right here for P1 and P2. You see S1 here, then P1 and P2. And if you look at the bottom of 228, okay, you can see that Service 1 gives 30% of its cost to Production 1 and 30% to Production 2. That's where these came from. So think of it this way: 30 plus 30 is 60. Okay, so if I take 30 divided by 60, I get 50%, and 30 divided by 60 is 50%. And so the direct method means we're going to take that 5,850 of Service Department 1 cost, okay, which came from the prior screen, or basically 2 screens ago right here, this 5,850, and you'll see the same calculation on the top of 228 again. So we're taking that 5,850 and allocating it to the 2 production departments. Okay, and of course we have to do the same thing to Department 2, to Service Department 2. And if you look at the bottom of 228, you'll see that they give 30% of their cost to Production 1, 60% goes to Production 2. So just think of it this way: 30 plus 60 is 90, and so 3 over 9 is 1/3, and 6 over 9 is 2/3. So 1/3, 33.33% of Service 2's cost goes to Production 1, and the 2/3 goes to Production 2. And the Service 2 has total cost to allocate of 8,250. So 33.33% of 8,250 is 2,750, and 2/3 of 8,250 is 5,500. Okay, plus the Phase 1 allocation amount, and that gives me my total cost. Okay, so 30,425 is my Phase 1 allocation plus my Phase 2 allocation, which is 2,750 and 2,925. So now my production department has all costs allocated to it for both departments, P1 and P2. Total cost I needed to account for was 66,000, and that same 66,000 comes from the grand total on the bottom of 227 in Exhibit 7.3, and you also see the same 66,000 in Exhibit 7.4 on the top of page 228. Okay, so then Phase 3 is we can then figure out the final allocation here, and we can look at the labor hours then for Product 1 and Production 1 and Production 2. We got the numbers they gave to us early in the explanation of the problem. 1,800, 1,800 is 3,600. 1,800 divided by 3,600 is 50%. That's where our 50% came from. For machine hours, it was 400 and 1,200. 25% is 1,600, 75% is 1,600. And then we can just do the math and allocate these costs based on these percentages and get the totals for each product. Okay, and again we get to 66,000. So okay, so that's how we get down to the direct method doing the allocations. Okay, now that was the direct method. Okay, so we're going to go now to the step method, and they begin to talk about the step method on page, and I should actually go back one step here. The direct method, they summarize this calculation, this 24,106 and the 41,893 in a little bit more detail on the bottom of page 229 in Exhibit 7.6. I'd probably actually spend more time looking at that than this PowerPoint, because they show you the calculation needed to get down to the 24,106. They show the 50% and the 25% multiplied by the cost that came from basically phase 1. Okay, so and you get down to our 66,000 total cost. So take a look at bottom of page 229, Exhibit 7.6 for the phase 3 of the direct method, and they kind of show the whole thing together in one big slide there, one big exhibit where you can see all the different costs that were allocated. Okay, so the next method then, remember there's 3 methods: direct, step, and reciprocal. And so now let's talk about the step method. Okay, so the step method, we're going to use the same assumptions, so nothing's changed. It's just now instead of using direct, we're going to go with step. And page 231 begins to allocate the step method because it's called the step method because we use a sequence of steps to allocate service department costs to production departments. Okay, step 1 is the same, doesn't really change, but then or I should say phase 1 doesn't change, phase 2 does change, and we're going to basically decide which department should be allocated first. And typically it's, when you get a problem like this, you're going to usually go with your S1 first and your S2 second. That's usually the way it's going to be set up in the homework problems that you'll work on and do. And so based on the numbers they've given us from the previous examples, we know that for Service Department 1, 40% of its cost goes to S2, 30 to P1, and 30 to P2. And we've got 5,850 of cost sitting in Department 1, Service 1, that needs to be allocated. And so based on these percentages and the total cost, we can do the math and get these allocations here. So that's step 1. We've now fully allocated away the 5,850 out of S1 into the other 3 departments. So the next step then is to allocate what's in S2, and S2 is made up of the original 8,250 that came from phase 1 plus this 2,340 that we just got from step 1 of phase 2. And so the two numbers together are 10,590. Okay, and if you look at Exhibit 7.7 on the bottom of 231, you'll see that 10,590. Look at the column that says Service Department 2. You'll see the calculation for the 2,340. Beneath that, you'll see how they got the 10,590, which is the 8,250 plus the 2,340. Okay, so this 10,590 needs to be allocated to Production 1 and Production 2. And we talked earlier that 30% of Service 2 goes to Production 1, and 60% of Service 2 goes to Production 2. And so that's a ratio of 1/3, 2/3. 30 plus 60 is 90. So if you think 30 over 90 is 1/3 and 60 over 90 is 2/3, that's our percentages. Multiply those percentages by the 10,590, okay, and now we've allocated this 10,590, 3,530 to P1 and 7,060 to P2. The phase 1 allocation numbers are right here, and we add these all together and we get our 66,000 total cost that we need to be accounting for. Step 3 of, or I should say, I'm sorry, phase 3 of the step method, let me say that right, so as not to confuse you, is then to finish the allocations down to product. And this should look fairly familiar from the direct method. the hours, the percentages for hours, the machine hours, the percentages for machine hours. Those are all the same as they were for direct. But now we're taking the 30,000, 35 that we received out of the previous slide right here, 30,035 and the 35,965. Okay, that's what we're allocating here to product 1 and product 2 based on the labor percentages and then based on the machine hour percentages. So the 30,035 and the 35,965 came from the previous slide. Okay, so once we've got these, we have to allocate them down to each of the products that we're manufacturing. Okay, and now we've got a cost per product and total cost of 66,000. Okay, the final one is the reciprocal method. The one thing to keep in mind is phase 1's the same for all three methods. It's phase 2 that really changes. For reciprocal, then phase 2 requires a little bit of math and kind of a solve for. It's not too bad. They're going to keep it simple because they're just going to give us 2 departments to worry about. It gets much more complicated when you have 3 or more departments, obviously. They describe the reciprocal method on page 232, and it's very important that you kind of understand and walk through this. And again, the example in the book is a little bit better than what they summarize on the PowerPoint. So be sure to read through what you see on 232 for the reciprocal method. So step 1 is to set up and solve simultaneous equations. Okay, and so we have an equation for S1 and for S2. And so for service 1 cost, we all know it's the traceable cost, the direct stuff, plus cost allocated from S2. Okay, so those are the total costs that will be in S1. We know the traceable is 5,850. That's been given to us. We know what that is. Plus, we found out earlier that for service 1, service 2 provides 10% of its costs go to service 1. And we found that if you go back to Exhibit 7.5 on the bottom of 228, that's where that 10% comes from. Okay. S2 then is initial cost allocation, which is plus allocated cost from S1. Okay, so S2 is 8,250, which has been given to us, plus the 40% that S1 cost provides to S2, 40% times S1. Okay, so that's our formula. So once we have that figured out, the next step is to plug it into the formulas down here. So for S1, it's 5,850 plus 10% times S2, and S2 is 8,250 plus 40% times S1. Okay, and then we can do the solve for using some algebra and some math and get that S1 is 6953. Once I know that S1 is 6953, then I look at the S2 formula and I go, okay, it's 8,250 plus 40% times S1. 8,250 plus 40% times S1, which is 6953.13, and I get an answer of $11,031.25. Okay, so to continue phase 2 then, I'm going to kind of go back to the same old, and I'm using those same percentages we have been using before in the other 2 methods, 30 and 30, 30 and 60, and I'm going to then use that to allocate these costs. And I should be telling you that on Exhibit 7.8, page 233, is where you will see a little bit more detail about these allocations and these numbers. So Exhibit 7.8, page 233, be sure to look at that. The 30 and the 30 were given to us, and that's used to multiply by 6,953, which came from right here. Okay, so we're splitting 6,953 times 30 and 30. And then the service numbers, the 3309 and the 6619, it's 30% of 11,031 and 60% of 11,031. And if I go back to here, the previous slide, that's my 11,031. Okay. And so this PowerPoint doesn't show that very well, but you'll see those numbers in Exhibit 7.8 on page 233. Then we add back the phase 1 allocation like we've been doing with the other examples, and then we get our totals in the magic number of 66,000. And so once we've got that, we can do phase 3, and then we can allocate back to each product like we've been doing before. So these numbers and percentages have been the same in phase 3 for every single method. What's been different is what we're multiplying that by, and this time we're multiplying it by the 30,145 and 35,855 to get to those numbers. So again, the bottom, or page 233, Exhibit 7.8 will show you each of those numbers in a little bit better detail than what we have right here. Okay, some implementation issues with each of these. They begin to discuss this on the bottom of 233. They also discuss it a little bit more on 235. And choosing the most accurate method is key, obviously. Each method can give you very different numbers. Now, they weren't super different with the example they gave us here, but in reality, of course, they could be very different. Determining the appropriate allocation base is obviously very important. Using direct labor hours and machine hours seem to make sense in this example, but you also have to make sure that you also have to make sure that you need to use a method that makes sense, and that there is a cause and effect. Okay, that's an important thing also. Okay, let's talk next then about joint product costing, and that's kind of the rest of the chapter. This begins on page 241, so you're skipping just a few pages. Top of page 241, joint product costing. It talks about some manufacturing plants yield more than one product from a common resource input. Okay, so we've got one resource input that can be turned into several different products, at least two, if not more. Okay, so that's what they call a joint product. Products from a joint production process each has a relatively substantial sales value. So both, or two or three or more products all have value. If there's a market for them, we're going to sell them. There's also what they call a byproduct, and a byproduct is very minor sales value. It just kind of comes along for the ride, just has a little bit of value that we can at least get some value for it, but it's not really what we're trying to manufacture. Okay, so they're going to give us a great example of this in the book. Okay, so for joint product costing, continued here, there's lots of terminology on page 241. I would make sure that you've got a good handle on what each of these terms means for a test, for a quiz. Just be aware of what those are. Joint products and byproducts start manufacturing as the same raw material. Up to a certain point, no distinction can be made. Okay, so they start out being the same product. At some point in time, they have what they call the split off. At the split off point, then we have at least two, if not more, identifiable products. Joint costs include all manufacturing costs incurred up to the split off point. And those joint costs are what need to be allocated to each of the new products that have been created at the split off point. So cost after split off are what they call separable processing cost, and we know what those are. Those are directly traceable to that specific product. So when it comes to your joint cost, the cost incurred up to split off, there's three ways to allocate those. Seems like we always have three ways to do anything. You can see what the methods are here. Physical units or measures produced, sales value of the products, and then what they call the NRV or net realizable value of each product. We'll look at each one, and the first one is cost allocation based on the physical units, and that is what's described on the bottom of page 241. The physical measure method is what they call it. And so we're going to use some kind of a measure, pounds, gallons, units, volume, to allocate joint cost to joint products. Remember that we've got this big pool of cost up to split off point, and that's what we're allocating is all the costs incurred to process the product up to split off point. This method is also called the average cost method when units of output are used in the costing procedure. So basically the way this will work is it kind of makes sense if we're using a physical unit of measurement that whatever output has the most volume will receive the most cost. You know, if that's in pounds, gallons, units, whatever it is. Okay. The example they're going to give us in the book, they'd start to describe it on the bottom of 241, and then they start to show it to us here on the top of 242 in Exhibit 7.17. We've got a seafood company, Johnson Seafood, and they process tuna. So just imagine a whole raw tuna. Okay, we're talking the tuna itself, the fish. And they're going to receive pounds of tuna and process it. You know, that means cleaning it and filleting it and the whole works. And then turning that into different products. Okay, and we're going to start out with two main products, tuna fillets and canned tuna, and then we've got a whole bunch of byproducts left over, scrap and waste. So $16,000 of tuna is what we have, which is 14,000 pounds, and that 14,000 pounds will turn into 2,000 pounds of fillets, which obviously has a different selling price than canned tuna, and then what's left over is 4,000 pounds of byproduct scrap and waste. So if we're going to use the physical units method, which is by far the easiest of the three, we're going to make it simple. We're going to say, okay, we've got 14,000 pounds of tuna that turns into 10,000 pounds of products we can sell. Tuna fillets are 2,000 pounds, canned tuna is 8,000 pounds, total 10,000. So you can see the fillets are 20%, the canned tuna is 80%. The allocation works out then to be 3,200 and 12.8, multiplying these times 16,000. Remember, that's my joint cost to allocate is 16,000. And so tuna fillets gets 20% of the 16, canned tuna gets 80% of the 16, and the cost per pound is the same for both. Okay, obviously a very simple method. It works. It has some advantages and disadvantages. Easy to use. The criterion for allocation of joint cost is objective. That's good. Disadvantages: ignores the revenue producing capability of each product. We know that the fillets are going to have more value than the canned tuna, so it ignores that. And of course, each product can have its own unique physical measure. You know, the canned tuna has a different measure than tuna fillet, obviously. Okay, the next method is what they call the sales value at split off method. So remember, we're figuring out what the joint costs are at split off, and so it kind of makes sense to say, well, what's the value of each product at split off? And so the sales value at split off allocates joint costs to joint products based on their sales value at the split off point. So if we have fillets and we have canned tuna, we're going to look at what's the sales value of each at split off and use that to allocate, okay? Knowing that fillets would have more value and have a higher sales price than canned tuna, and you can see what that is right here. So page 243 is where they show us examples of the split off method or the sales value method. They describe the sales value method on the bottom of 242, and so what you see on the screen right here is the same thing as Exhibit 7.19 on page 243. Remember, we have 10,000 pounds of products we can sell, 2,000 of fillets, 8,000 pounds of canned, and the sales price per unit is $2.20 for a fillet and $1.65 for canned. You can see the sales value of each based on that total sales value of $17,600. The proportion is 75% of that is canned, 25% is fillets, and we'll use that then to allocate. So we're going to say of that $16,000 worth of cost to allocate, 25% or $4,000 goes to fillets, 75% or $12,000 goes to canned, and we get a different cost per pound then, which probably makes a little bit more sense than what we did with the previous method. And so sales value at split off, Advantages, again, still easy to calculate. Costs are allocated according to the product's revenue, which might make a little bit more sense. Disadvantages, though, market prices can change constantly. I would imagine that the market price for fish would change a lot based on supply and demand. So that might not be a good one based on that. Sales price at split off might not be available because additional processing is needed for sale. So that's a possibility also. It's possible that that sales value isn't known at that point. It was in this example, but that's not always the case. The third method is what they call the NRV, or net realizable value method. That method is described on 244 and 245. They describe it on 244, and then in the bottom of 244 you'll see Exhibit 7.22, which will then kind of walk us through how it's done. So net realizable value is, it says, can be used when joint products cannot be sold at split off. So in other words, might there need to be extra processing before a product can be sold? So just because we have that split off point where we have two separate products, it's quite possible one or both or more of these products that have been separated need additional processing before they can be sold to customers. Okay, so net realizable value is estimated sales value at the split off point, and that estimated sales value is determined by subtracting additional processing and selling cost beyond the split off point from the estimated ultimate sales value. So we're guessing the total sales value of the products. We're subtracting the additional processing cost plus selling cost, if that's distribution cost, commissions, whatever that is. Okay. And so you can see that on the top of page 244, Exhibit 7.21 is what you see on the screen. And so the example they're giving us now, remember that we got 14,000 pounds of tuna, 2,000 becomes fillets, 8,000 becomes canned tuna, but now they're saying of that extra 4,000, 3,000 can be turned into cat food, so it's maybe not fit for human consumption, but we can turn it into cat food. And then we still have 1,000 pounds left over, that's just scrap or waste or byproducts that'll just be disposed of. Okay, and so we've identified the fact that the tuna fillets at split off can be valued at $2.20 a pound. The canned tuna at split off is worth $1.65 a pound. But the cat food requires additional processing before it can be packaged and sold to a pet food distributor. Okay, and so at 3,000 pounds worth of cat food quality tuna, it needs to be processed a little bit further. In the book, they talk about adding some minerals to it and so on, and making it fit for cat consumption. And we're going to sell it to a pet food supplier at $1.75 a pound. Okay, so that's kind of the extra step that the other two methods did not have. And so based on that, we've got 13,000 pounds worth of product that now can be sold, okay, as opposed to 10,000 that we had earlier. Each product has, of course, a sales price, and so the sales value then is just the multiplication of pounds times price. However, cat food needs additional processing, right, an extra $8.50. So we've got $22,850 as sales value, but we've got $8.50 for cat food of extra processing cost before we can sell it to the cat food manufacturer. And so the tuna fillet is at $4,400, canned tuna is at $13,200, but then the cat food is $52.50 minus $8.50 to get down to $4,400. Okay, so total realizable value $22,000, and the percent of each is 20, 60, and 20. The allocated cost then is just multiplication of 20% times 16 for 3,200, 60% times 16 for 9,600, and so on. And so my total cost then is the 3,296 and 4,050 because it's the 3,200 plus the 850. That's my 4,050. My cost per pound then, you can see, comes out to be these numbers here. So obviously this one, because it has extra steps, would be the most accurate when it comes to all the methods. And so that's it. I'm not going to cover byproduct costing with you. I don't think we need to worry about that. It's plenty complicated enough in this chapter of what we've been looking at. So that'll do it. Thanks.